To start this problem off, I'm going to draw your attention over here to this T account that I've created for us to help us keep track of what's going on with these investments, this common stock that we own in Shelby Laminations. So we bought $50 million worth of their stock on November of 2015, and we are told that's 12 million shares of the stock. We're told it's classified as available for sale, and that's certainly significant. Because it indicates as to how we will recognize any gains or losses as a result of changes in fair value. So I'm just going to start with having this asset that should show up on the balance sheet classified at its cost, which is accurate because we're in 2015. We bought it and go into our records at its historical cost. So subsequently what happened was the price for some reason went up in this common stock, and we're selling 1/2 of our shares. It only looks like less than a month or so later for $26 million. So we intended to hold it for a period of time. The stock price went up. It was too attractive to resist selling it. Maybe we needed some cash for some reason, and we're going to go ahead and sell half of it. So we're going to take the first journal entry we're going to look at is actually liquidating half of this stock, which means this is the cost, the $50 million, and half of it's going to go away. So I would credit this asset account, this stock investment account, for $25 million. So right down here I've created an area where we can do our journal entries. And so on December 9th of 2015, we are going to receive cash, and we're told we sold it for $26 million. So the proceeds we receive are $26 million. Now subsequently we're only going to take out of the investment account $25 million because that is our cost. So I would credit this investment in Shelby for only $25 million, which leaves us with a $1 million difference. And because it was bought and sold in the same accounting period, we're going to record a gain on sale of investment for $1 million. Which is logical, right? We made $1 million on the sale of the stock, and the accounts correctly reflect what happened. The asset now is only on our books for $25 million. This $1 million gets booked into the current year's income statement as a gain, and we'll talk about that in a little bit. But that takes care of the first transaction. Now 20 days later, we receive $1.5 million in dividends from our remaining common shares that we own. And so again, it's important to note how much of the investment we own, because if we're taking the equity method here and accounting for this dividend, it's certainly going to be way different than what we're doing, than what I'm going to show you, which is an indication of it not being an equity investment because we own less than 20% of all the common shares. We can make that assumption because it's been classified as available for sale. So on December 29th of 2015, we are going to receive cash of $1.5 million. Now what do we credit? That's the question. Fairly simple, actually. We're simply going to credit this account called investment revenue for $1.5 million. And that as well would hit the profit and loss statement in the current period 2015. Using the equity method again, that would be way different, but we're not talking about that. So that was simple. None of the balance sheet accounts up here relative to the stock are changed. I have two other T accounts we'll look at in a second here, which is why those are sitting there. So on December 31st now, we're saying, okay, and that's kind of the emphasis of this chapter, is what happens when we buy equity investments in a company, and the value subsequently goes up or goes down as a result of the market price of whatever investment we own. And so we're told at the end of the year the stock is worth $4.25 a share. Okay, well, so what? Right now sitting in this account is $25 million, right? Because it's $50 million less the 25 we liquidated. So we have $25 million left, and that represents 6 million shares because we originally owned 12 million, we sold 6 million, so we have 6 million left. So if I take that 6 million and I multiply it by the $4.25, hold on, the 6 million times the $4.25 per share. The value, because that's what the value is at the end of the year, the value is $25.5 million. The argument then is that this balance sheet is not correctly stated. We're undervaluing our assets by $500,000 because there's $25 million in there now, and we're showing that there's a logical tie or into what it should be worth, which is $25.5 million. And you can't really argue with that figure because it's traded on an open market. Okay, so logic would say put $500,000 into this account, but we don't do that. We preserve the historical cost in this account. We create a special account called the Fair Value Adjustment Account. And I'll create that account for the Shelby Laminations stock. You could do it maybe just for an entire portfolio for available for sale securities. So what's going to happen at the end of the year, December 31st of 15, instead of debiting the stock investment for the $500,000, because we know we're off by $500,000, the fair market value and our book value don't match, we're going to try to get the book value up to $25.5 million. Instead of pushing it here, we're going to push it into this, what we call a valuation account, the fair value adjustment account. So then the idea is between these two accounts, if you net them together, it will give you what the fair value of that stock should be. So we need to add to this account $500,000. And then between the two, we'd have a value of $25.5 million, which matches my market value at the end of the year. So I'm going to debit this fair value adjustment account. Fair value adjustment, and maybe just abbreviate for available for sale securities, and $500,000 went in there. I know I'm going to have to credit something for $500,000, and this is the most important part, I think, of the transactions that we're looking at, and that is, well, where does that $500,000 end up going? There's an argument that, well, you bought the stock, it went up in value, you should recognize that increase in value as income, and you should increase profit in the current year. And that would be true if this stock were classified as a trading security, because our intent would be to sell it within the next 3 or 6 months. But that's not our intent, even though we did sell some up here. Our intent, at being available for sale, is to sell it at some point in the future, and we don't know when that is. So the FASB argument is that no, you don't take that $500,000 and put it into income in the current accounting period. You take that $500,000 and you push it through to this account called net unrealized, because it's not a realized gain, it's a net unrealized gain, it's a holding gain, net unrealized holding gain / loss. We would combine them both in here, and this is, we would put dash equity is what we learned in class. I'll just put here in parentheses OCI, indicating that it goes to other comprehensive income on the balance sheet as opposed to going to income on the income statement. That's significantly different. So now I've got an account here called net unrealized holding gain / loss, OCI. Shows up on the equity section of the balance sheet, and it has $500,000 in there. And the idea is to bypass the income statement, not to confuse the current income with these fluctuations in the market value for securities that we own. And so this $500,000 is a benefit to the shareholders, and we're showing that's a benefit by an increase in equity, this unrealized holding gain and other comprehensive income. So that's the entry at the end of the year to record the adjustment for the market value, given that the stock is available for sale securities. Had it been trading security, then it wouldn't have gone on the other comprehensive income. It would have gone to the income statement. We'd have an unrealized holding gain / income, and so that gets us through the first year, which is 2015, and all the corresponding entries.